So we're going to go through just a brief overview of non-for-profit accounting. So let's get started. General characteristics that are unique to non-for-profit organizations. They generally receive contributions from donors. They don't have customers necessarily. The donors don't receive something in return that's tangible, typically services, for instance, or goods. The operating purpose of non-for-profits is not to provide goods and services for profits or to their donors, but to a particular mission, maybe people in need. There's no ownership, there's no equity. Non-for-profit exists for the benefit of others. They may be governmental or private. So here's some examples: charitable, Red Cross; educational, Middle Georgia State University; civic, like Boy Scouts; political parties; trade unions, and so forth. So the key accounting and reporting differences are these five. They have change in net assets instead of net income. They have inflows, not revenue, although they can use the word revenue. And these are generally not earned. There could be a portion of their inflows that are earned. For instance, Red Cross sells blood. Boy Scouts sells a magazine subscription. So there can be some components where there actually is a customer kind of transaction, but those are typically not, a major part of what they're doing. The key here, the third one, is something that everybody has to comply with. Expenses are split into two categories. The expenses of giving out the programs that are related to the mission, and then support, which is administrative and fundraising. I'll show you a couple examples of that. There's no equity section on the balance sheet. There's just something called net assets. And something unique to non-for-profits is they can actually recognize contribution revenue if they get an unconditional pledge. So that's something that's sort of unique to that area. So the Financial Accounting Standards Board has jurisdiction over private non-for-profits. Governmental ones come under the governmental accounting rules. And there's two basic things that FASB has said about reporting for these kinds of entities. One is should focus on the entity as a whole, and that it should be accounted for similar to business entities, which you already know how to do that, unless there's critical differences in the needs of users. So we'll look at some examples. So you customize for the non-for-profit when it's unique to them. Otherwise, you use just the standard accounts and the standard way of accrual accounting that you already know. So there are 3 required or potentially 4 required financial statements. There's a statement of financial position, so that's the balance sheet. That would have assets, liabilities, and net assets. Statement of activities and changes in net assets. That's instead of the income statement. Some folks just call that statement of activities, but that's basically the inflows and outflows from transactions, programs, and support. Statement of cash flows, which is very similar to what you're used to. And then a fourth one, statement of functional expenses. That's required for health and welfare organizations, but it's recommended for all. So some of them do it anyway, even if it's not required. So let's have a look. Here's the American Cancer Society. They are a health and welfare organization, so they are required to report their functional expenses. Well, what's a functional expense? Well, this is from their statement of activities. You can see I've got activities in a red box up there at the top. And then they list out their programs: patient support, research, prevention and detection and treatment. And then they have their support services, management or administrative, and fundraising. Those have to be separated out from programs. That can't be commingled. So there's your 2 main sections that nonprofits have. And since they're a health and welfare organization, they are required to report the functional expenses. What does that mean? So salaries and payroll taxes and rent and travel, you can see down the left that they call those functional expenses. And it's sorted by the programs and administrative. See, patient support, let's go back over here. That was the first program over here. So now we have the salaries in that particular program and so forth, and research. So there's their 4 programs, and then their 2 support, administrative, and fundraising. So they have to separate out within those programs and within the support how much did they spend on salaries and the other kinds of functional expenses. And then on the balance sheet or the statement of financial position, the unique part is the net assets. Here is American Cancer Society's net assets, and it's split into unrestricted and restricted. So this was 2016, and so there was a change. FASB just decided to have unrestricted and restricted. So the restricted doesn't have to be split into temporarily restricted and permanently restricted. That can be discussed in a footnote. But since this is created before that change, you see those two categories. A couple things to remember about the statement of activities, which is their version of the income statement, that the change in net assets is just the difference between the revenues and expenses. It's reported instead of net income. The unconditional promise to give or pledge is recognized as revenue and a receivable when they promise it. And then, of course, it's for accrual basis, just like a for-profit business organization. Here's an example. Here's the statement of activities for the American Cancer Society. I've cut out the program since we've already looked at that. And interestingly, they show their program expenses first, and then they show where they got the funding second. So there's no requirement that the funding come first, like in for-profit, where revenue comes before expenses. So here you can see where they're getting their support. They have quite a bit from special events. They have just straight out contributions. They have bequests where people have died and left money in their will. And then there's contributions in kind where people give them services or products as opposed to cash. All right, and then they have an endowment, which is permanent contributions that can't be spent, but the income off of it can be. And so you see some activity here from those investments, and then it goes down to net. Here's the American Cancer Society's statement of cash flows. This is the direct method, so you can see that the things that are coming in and going out are unique, and so that's what FASB wants. It wants the pieces that are unique and important to highlight in the report, but otherwise stick with the generic. Here's that same cash flow in the indirect. Notice the first line is not net income, it's change in net assets. And then the other adjustments are fairly similar to what you would expect, depreciation and gains and losses and that sort of thing. So that's not that foreign. Here is the top of the balance sheet for Red Cross. And you see both trade receivables and contribution receivables. So trade receivables is, of course, they sell their blood to hospitals. And so they do actually have regular receivables for products that they sell, but they also have contributions receivable for pledges that have been made that are unconditional, and they're allowed to recognize those. Here's the bottom half of their balance sheet, and the liabilities look pretty similar to what you would see in a for-profit. Nothing particularly different about any of those categories. What's different here, of course, is the net asset section. So they've got the unrestricted. They've got some long-term liabilities related to pension in their net asset section. I'm not sure why. That's probably some unique reporting I just haven't been exposed to. And then going forward, you would just add those two together. You would have one line restricted assets. You wouldn't split them apart on the face of the balance sheet. But this was created before that change in the rules. Here's Boy Scouts of America. Notice they start with their program expenses and then their supporting services. Programs are very different from what you saw at the American Cancer Society and the Red Cross. Field operations, human resources and training, and so forth. Now, they are not health and welfare, so they are not required to report functional expenses. Remember that? They are required to split out program and support, which they've done. So they've got management in general or admin, and fundraising split out, which they've done. But the question is, did they voluntarily report their functional, which was recommended but not required? And as it turns out, they did. So here's just a little piece of it where for their various programs, they did show you salaries and benefits and rent and so forth. Here is the top of their change in net assets. So this is where they're getting their funding. So they charge fees to the various Boy Scout troops. They sell some supplies. They sell a magazine subscription. They have contributions. So notice how this is really customized. The line items here in the income statement are customized to this particular nonprofit. So it's not as uniform across organizations as for-profit entities are. Here is a labor union. All right, so very simple balance sheet because all they do is collect cash. They don't own anything. They don't offer other types of services. So very clean kind of balance sheet here. Only liability they have is where they have withheld dues from payroll and haven't remitted them to wherever they're going to go. And of course, all they have is unrestricted net assets. So very simple. This is from a political action committee, and so they have very little activity. Very simple, right? They just have one thing that they do, and they have two kinds of expenses, and that's kind of it. So in this case, it wouldn't make any sense to have program and functional expenses because there's just too little going on. So you can sort of see the variety, the range of financial statements that you might see in the non-for-profit world. So let's just review the key differences. You have change in net assets instead of net income. You've got inflows that are not earned or matched with expenses. You've got expenses split into the two categories, programs and support, as long as it makes sense for that organization, but typically it would, especially any organization of size, not a tiny labor union. There's no equity sections, just net assets, and you can recognize contribution revenue with an unconditional pledge. So those are sort of the big ideas. So let's see how well you have absorbed what we've talked about. Freeze your frame, think about this, make a selection, and then we'll talk about it. So here you can record contribution revenue, so that would be E. Freeze your frame, think about it, make a selection, and then we'll talk about it. So they are required to do the financial position, the functional expense, the statement of activities, and cash flow, but not a statement of operations. That is a for-profit report. Freeze your frame, make a selection, then we'll talk about it. So they are classified by program and supporting. Freeze your frame, make a selection, and we'll talk about it. So this one's a little more difficult because it requires you to process more deeply what we've been talking about. Let's take a look at the first one. $2,000 specified the donor to be used to pay salaries. So that is restricted. The $10,000 for the new conference room furniture, they got the cash. They will record contribution revenue for that. And then the $5,000 to be held for 1 year before being expended, they will record contribution revenue for that. The question though is, so the contribution revenue would be for the whole $17,000. The question though is which one of these three is restricted. So net assets is going to go up by the $17,000, but the question is how much of the $17,000 is unrestricted and how much is restricted. So the salaries are paid in year 2, so in year 1 they're still restricted because you can't use them for anything but those salaries. So the $2,000 would be in the restricted column. The $10,000 was purchased in year 1, so that's not restricted. The $5,000 can't be spent in the first year, so that's restricted. So net assets is going up by 17, 10,000 unrestricted, 7,000 restricted. So in this case, it would be answer B. So thanks for paying attention and good luck.